Key factors in qualifying for a mortgage. What are the key factors that mortgage lenders look at when assessing whether or not a prospective borrower qualifies for a home mortgage, as well as the amount they qualify for and on what mortgage terms? We will look at four primary factors that are used by mortgage lenders. 1. Employment income. 2. Credit rating. 3. Loan-to-value ratio. And 4. Debt-to-income ratio. Employment income. The rule of thumb is that most borrowers can afford, and hence most mortgage lenders are willing to lend money for a home that runs about 2.5 to 3 times the borrower's annual salary. Credit rating. Before mortgage lenders extend credit, they assess the borrower's credit rating. Lenders use the credit rating to decide whether to lend money, how much, and at what interest rate. The credit rating consists of a credit report and a credit score. A credit report is a report of a person's credit history. A credit score is a number that represents the credit worthiness or the lending risk that the person represents for lenders, compared with other consumers on a scale from 300 to 900. High scores on this scale are good. The higher the score, the lower the likelihood the person will default on his or her mortgage, and hence the more likely lenders will extend credit at lower rates. This score is based on an assessment of the person's character, income, economic history, such as duration and type of employment, debt payment history, timeliness of payments, and assets, savings, or other property. Loan-to-value ratio. Loan-to-value ratio is a financial measure used by mortgage lenders that helps to assess the risk of not recovering the total amount of the loan in the event the borrower defaults. It is one of the key risk factors that mortgage lenders consider when qualifying borrowers for a mortgage. Loan-to-value ratio quantifies the amount of the loan relative to the value of the asset being purchased. To calculate the loan-to-value ratio, divide the loan amount by the property's value. If the loan-to-value ratio is above 80%, in other words, less than a 20% down payment, the rates may increase significantly. Moreover, the borrower will also likely have to purchase mortgage default insurance to protect the lender from his or her defaulting, which increases the cost of the mortgage. Alternatively, one can find a less expensive home or save up a larger down payment to lower the loan-to-value ratio below the 80% threshold. Lenders prefer not to lend out more than 80% of an asset's value for the simple reason that doing so might result in lenders having to suffer a loss in the event the asset decreases in value on the open market. By getting borrowers to front 20% of the cost means the mortgage lender will not likely suffer any loss due to depreciation in value. Debt-to-income ratio. Debt-to-income ratio is a financial measure used by lenders to assess the burden of an individual's debt obligations relative to his or her income. Debt-to-income ratio is the percentage of income that goes towards paying all monthly debts. Debt-to-income ratio is another key risk factor lenders consider when assessing borrowers for mortgages. Mortgage lenders use debt-to-income ratio to determine how large a mortgage the borrower can afford after all his or her monthly debts are paid. To calculate debt-to-income ratio, add up all monthly debts, not only mortgages, and divide by the monthly income. A debt-to-income ratio between 20 and 39% is usually considered good and will help a person be perceived as financially stable. For more informative videos on home mortgages and related topics of a financial and legal nature, we welcome you to subscribe to our channel. Thank you.